Hey everybody, Brian here, quantlabsnet.com. Today's video, I'm going to go over what we call interest-free rate, risk-free interest rate as well. This can be found in the standard Black-Scholes model formula. There seems to be some confusion. I always would have thought 10-year Treasury monthly rate would have been fine. At the end of the day, that's what I'm using for now, but I'll probably readjust it to whatever the industry uses. But for now, let's go over this question found over at quantsstackexchange.com, doing analysis on ETF mutual funds that track same index, US funds only, blah, blah, blah. Calculated beta or beta, Kovar variance. Now I want to calculate the beta or beta and Sharp, etc. Now, doesn't know how to get the risk-free rate to calculate further calculations. Idea to take a 5-year treasury bond, monthly data, and calculate average of that and have it in a single cell for calculations. Is that the right way? All right, so this resource is fantastic for anyone wanting to learn about quant stuff. Just as a tidbit there, government bond yields are generally not the preferred risk-free rate. Monitor textbooks and predict practical application. Now, this can change as we move on in terms of more risk is out there with government issued bonds as they continue to print money. So it's more risk, just to remember that. Nowadays, risk free swap rate, SOFR for US, uh, Euro, STR for Euro, for example, are used, but you usually have a choice for other swap curves, legacy reasons like different OIS swaps, Fed fund rate swaps. Um, So I missed something here. Particularly true in contexts such as pricing, derivative. That's what we're doing a lot of is derivative. Plus, we can also include risk management, IRBB. This guy knows what he's talking about, whoever it is. Let me see who it is. AK Academy. So they probably know what they're talking about. Bloomberg does not even offer government bond curves for this. The risk-free low interest rate in all of their derivatives pricing. Clearinghouse and exchanges. Let me just go back here. So there's all this scholarly work in the academia. Several papers on treasury are not a good proxy for a risk-free rate based on convenience yield arguments. Okay. Clearinghouse is probably the better, safer place to go. Um, Standard for clearinghouses and exchanges like LCH and CMA use RFR rates for discounting, done with risk-free price alignment calculations, which is the interest paid on the collateral that is held. Okay, so got the links there. Regulators don't see government curves as the appropriate risk-free rate. Um, so I'm not going to go into these sections here. ESTR is unsecured. Explanation for this can be found in ECB as official rate. I mean, this is US based, I would think. All I'm doing is US specific for me. That's the majority of it. Official risk rate for alignment, interest rate discounting all major CCPs, and it would be difficult to argue why would one not use ESTR on my team's opinion for IRBB. Okay, so there's the book Hall Options Futures. Anyways, you can get into that, but you can see that there's many different reasons. This one, the standard to use risk-free rate from FAMA French. Data is available here. Uh, okay, I can download mine. That comes from the Fred, St. Louis Fed. Um, PDF is not searchable in sectional LA. Data is silent about the risk-free rate. Related unanswered question about risk-free rate from Ken French's database here. There are many free tools that will search a PDF through the OCR and output. Searchable, markdown, these are all minor stuff. Monthly rate of return is not known in advance, so it's not risk-free. See, there's many different people that argue this. The monthly rate return on 1 month T-bills known in advance, assuming the government never goes bankrupt and always repays their creditors. So this is an actual risk-free rate. But here's what's important here from this person here. US, that's assuming that the U.S. government never goes bankrupt. What about going into defaults? The next question. However, AK Demi answer on why government bond yield is not the preferred choice of risk is the industry. RFR swap rates are recommended instead. Okay, so there's your answer. As for me, as I'm using a 10-year, maybe 5-year, but for me, I'm just doing guesstimates right now. If you got some that you think's better, let me know. And if it's downloadable, even better, let me know. And I'd like to know the URL that you would use. Thanks for watching. And again, that comes from Black-Scholes here, which I put up yesterday on a video or 2 days ago. So if you look for the formula, let's just see what the formula is. This is on Investopedia right here. So R in the formula would be risk-free interest rate. We've gone over that in that prior article. If you want to know more, you just go to quantlabsnet.com. And then if you want to know more what I'm doing, HFT like, high frequency trading like, just go to the Learn tab here and click that. Enter all your information in here, and you'll get into our newsletter database. So you might get an email from me every day if you want, depending upon how you engage with it. All your info is not released to anybody except little me. Thanks for watching. Have yourselves a good day.